every ETF portfolio get the trick done? And what are some of the biggest mistakes ETF investors make? Here to tackle these questions and more is Rick Ferri. He's an investment advisor, CFA, and serial author. Some of his books include The Power of Passive Investing and All About Asset Allocation. Rick, welcome to the program. It's great to have you with us.
Well, thank you for inviting me.
Of course. Let's start with the 2010s, which have come and gone. And in retrospect, it was a great decade for stock investors. The Vanguard Total U.S. Stock Market ETF, ticker symbol VTI, climbed just over 252%. So my question is this: do you think the incredible run in stocks has caused some investors and maybe even some financial professionals to underestimate the reality of market risk?
No, at least not the people I talk with, although I'm talking with a small population of people who generally have financial independence and have made money. I think that they're more scared now of the market than they were back in 2010. So the reality of market risk is still with people from the financial crisis, and I don't see the kind of brushing away of risk that we saw, say, in the late 1990s. And I've been in the business for more than 30 years, so I came in right after the market crash of 1987. And so the risk of the financial crisis is still with a lot of people. And so I haven't seen that, even though this big run has happened. I think people are more afraid now, perhaps, than they were at the beginning of 2010.
You've talked about the benefits of an ETF portfolio with just 3 funds, but some people think it's crazy. Some would argue it's oversimplification at best. What's your take?
Well, all you need is the return of the stock market and the bond market to get you to your financial goals. The people who are saying that that's oversimplification are usually people who are trying to sell products. They're trying to sell mutual funds, or they're trying to sell money management services that are much more complex, much more expensive, and generally are not nearly as tax efficient as just buying a simple total U.S. stock index fund, a total international index fund, and then maybe a bond fund. Certainly the data has not panned out that way of investing is riskier. It's certainly less expensive. It certainly has produced fine returns for people, not only in the last decade, but over the last 30 years. In any market environment, the simple allocation to 3 funds does relatively well. It's not always the best performing, but it certainly is the least expensive. It certainly is very tax efficient. So I don't believe the people who are saying that you need anything more than that.
If you're just joining us, Rick Ferri, author and investment advisor, is with us. Investing great John Bogle died in 2019, and he radically improved the way we invest today. What specifically impacted you about John Bogle's life, his philosophy, and his approach toward investing?
All those are it. His philosophy and his approach towards investing are what influenced me. I started out in the industry back in the 1980s as a broker, and I was working in large brokerage firms, not unlike what are out there today. And it was all about product sales and all about trying to earn a rate of return for the shareholders of the brokerage industry that I worked for. It wasn't about earning a good return for the clients. And I was about ready to quit the industry in the mid-1990s until I read John Bogle's first book, Bogle on Mutual Funds, and that was an epiphany for me, and I became enlightened to how investors should be managing their money, not necessarily how Wall Street wants you to manage your money or how investment advisors want you to manage your money. So when I learned about this way of investing, it made complete sense to me, and I just changed my whole business philosophy and changed my whole life to pursue this professionally and try to help spread the word about low-fee investing and even do-it-yourself investing. It's really not hard to do.
Over the years, you've critiqued both the financial services industry and its advisors. I can't let you get away without asking it. Do you think financial advisors overcomplicate the investment process?
Oh, of course. I am a financial advisor now, but now I'm just doing it on an hourly basis, so I have no skin in the game. But when I was in the brokerage industry as a financial advisor, it was all about what is my commission going to be if I sold you this product? How much fees am I going to get paid if I sold you this product? Then when I left there and started my own asset management company where I was managing investment portfolios, I created model portfolios that I was trying to put people into and get them invested so that I could collect fees on those model portfolios. But those models, although they were relatively low cost and simpler than most models, were still probably more complicated than they need to be. If you are just putting together a portfolio for yourself and you're just using very low cost total stock market, total bond market index funds or index funds that are like that, you don't need a financial advisor. You don't need to pay for the complexity. I don't think the complexity gets you anywhere. Besides paying higher fees, it doesn't get you higher returns. It probably gets you lower returns because of the fees involved. That's what I know to be true. I'm not saying that I believe it to be true. I know it to be true. Fees drive your returns lower. The more you pay in fees, whether it's to mutual funds or the more you pay in fees to an advisor, the lower your return is going to be. It's just simple math.
Okay, next up, we need to talk about brokerage platforms like Charles Schwab and others who have courted independent investment advisors. And to a certain degree, they owe a lot of their success to these advisors. But it seems like these same platforms, little by little, are encroaching and competing with the very advisors they have courted. How do you see this playing out?
Well, advisor fees are the last bastion of gluttony in the investment industry. Commission costs have literally gone to zero. Schwab doesn't even charge commissions anymore. Neither does TD Ameritrade or Fidelity or Vanguard when they're buying and selling ETFs or stocks. There is no commission cost anymore to an individual investor who trades online. As far as the funds themselves, the cost to buy an index fund, the internal expense of an index fund has really gotten down to almost practically nothing. In fact, Fidelity has zero cost index funds now. So where's the money? The money is in advisor fees. This is where the last bastion of gluttony. Advisor fees have not really come down like everything else have come down. The typical advisor fee on $1 million portfolio is still 1%, which is incredibly, ridiculously high. And this is the brokerage firms on Wall Street, see this, and even the fund companies see this, and they say, well, we need to encroach on that industry so we can maybe start collecting some of the fees that the advisors are currently getting. So it's no surprise to me that it's occurring.
Okay, well, Rick, thank you so much for your insight and for joining us. You just heard from Rick Ferri, author and investment advisor. I'm Lynn Dolan with ETF Guide. Thanks for watching.